All right, we're getting the live stream ready.
Okay, the chat alert looks good, Jason. Text and email look good.
Excellent.
All right, and
Got
Greg.
some guests joining in.
Yep.
If you do have a microphone, we have a bribe for folks on their free trial. If you do chat with us, we're going to extend your free trial by a week. Now, for those of you who are already members, let me just go over my expectations. I still believe TLT and GDX are going to pop significantly. And so that's why we're not selling a call option today. They've been pushed to extreme lows. The SPY has been pushed to extreme highs. And we'll talk about what's shaping that. Obviously, the Trump tweet this morning, if you didn't catch it. But the catch is the biggest banks in the world, primarily JP Morgan,
Jason,
are now underwater on a record level amount of treasuries. So I think we're going to see a huge spike in the next month or so. And so the potential I'm looking is to see a 10-point rise on TLT.
Hey, William, we can hear you loud and clear, bud.
can anyone hear me?
Yes, sir. How's it going?
Can anybody hear me?
Yeah, we hear you. What's your name, bud? It just says guest on our screen here.
This is Jeff, and I heard what you said, Jason. On embedded in your paragraph, it still says go ahead and close your calls.
Yeah, close your previous call. You have to do that to for sure.
I thought we were going to keep them going. Don't close them.
No, today. So trade alert today is buy to close. Here, I'll pull up the trade alert.
Oh, so it says do not sell any calls.
Right. Yeah. So the nature of here's the nature of our different instruments. We'll look at this in the webinar. The nature of the TLT and GDX are really to trade flatter down.
Okay.
The environment is not scary, but the second bad news hits, it spikes really high. So in this setup, we're going to be hanging on to some volatility until the bad news hits, and so the SPY tanks and your TLT pops. Now, to save some money on the put options, we're just purchasing the 10th, 2020.
Okay, so there's no change in what we're normally doing then.
Yeah. Hey, Jason, can you mute that top guest? Okay, cool. Perfect. Thank you.
I guess that's what I was trouble hearing, but.
Okay. Sure. So here's your step-by-step. We're not changing the underlying.
Right.
We still have the exact same position. Luckily, we had that 138 put, so we paid a premium just in case this would happen, in case the trade talks. My expectation was the trade talks would either escalate, was the most likely outcome. That's what all the trade advisors want. But then you have kind of Trump's internal staff that just wants to get through the impeachment and then win the election next year. So from that standpoint, I thought it was possible to delay tariffs. And the least likely, I thought, would be a signed trade deal. So the news this morning is that Trump is offering to reduce tariffs by 50% on all the previous tariffs and delay the current tariffs if China pledges to make agricultural products. So no, it's not a real deal of any nature. And so to save a little money, so I'm still expecting, the big picture is the bond market's really in trouble. And we'll look at that in our webinar presentation. But bonds must go to lower interest rates, or everyone and their mom who loaded up into low yielding bonds are going to flee for the exit. If that happens, we have chaos in the credit markets. So there's very little chance any Federal Reserve is going to allow that to happen. They'll just start to really ramp up quantitative easing. So that's what I suspect. And we'll take a look. Here's the most interesting chart.
I understand. So we're not going to sell a call because we think the TLT might go through the roof.
You got it. Yeah. And when we look at the,
we don't want to cap our gain on a potential
Yeah,
something.
exactly.
I got it.
After
Okay.
hanging on to that position for 3 months, and you know what? They were all warning that this was going to happen because they want to force the Fed to lower rates. So here's the big picture. This is the most connected group of people to the Federal Reserve as well as the government are the primary dealers. If you're a primary dealer, that's a very exclusive position. And essentially you get the first stab. In fact, you have to purchase the treasuries. And so here's what's interesting is that the primary dealers are not flipping their bonds. All year they could have been flipping these bonds, but instead they're accumulating them as collateral. And now they're at a near record high, especially on that long end of the treasury curve. So if we do look at our yield curve right here, let me zoom it. Let's see if it lets me zoom in on it without, where'd it go? Okay. Oh. All right, some fun music. We got a bunch of guests joining in. Let me unmute everybody. Welcome. Tom, William, Jim, how's it going?
Good.
Excellent. So yeah, let me just show you guys what I think is going to happen. So you can see that yield curve is probably a new to some of you folks, but essentially the Fed came in after the yield curve began inverted. So the healthy curve of the yield curve is just slightly sloping up. And the point is that interest rates should get a little more expensive the longer you're going to loan money to the government. And every time that gets out of whack, all of a sudden you make more money lending the government short-term debt versus long-term debt. That's what they call an inverted yield curve. And every time that's happened, almost within 18 months, we went into a recession. And so the Fed immediately reacted to that and went in and started buying in the T-bills. So that's the front end of your yield curve. Any treasury that's below a 1-year expiration is your T-bill. And so let me just simplify this. Let's look at today's versus, let me pull off a few of these. Okay, so here's where we're at currently. And so you can see in September, they did the emergency meeting and all of a sudden started up quantitative easing in this repo market. They didn't really tell anyone why. They told us, in fact, this should be like a 2-week little technical glitch because of tax payments. But we're quickly learning that's not the case. And the balance sheet has grown at the fastest pace in all of history. But let's look at what happened to rates right before that meeting. So we go back to August and you can see it's messed up. You're not supposed to get paid more and this has been the Stanley Druckenmiller pitch. If you remember the Bloomberg interview last December, he was telling everybody to load up on that 10-year. And boy, oh boy, did they. And it ended up inverting the yield curve. So if you notice the turquoise line is you get paid more for that 1 month, 3 month, and 1 year bond. And you get paid less for the 3-year, 5-year, 7-year. And so that messes up the way banks make money loaning to consumers and businesses. So what did the Fed come in and do? Well, they have started buying $60 billion a month so far, just on the front end of that curve. So you can see it worked, at least for now. The middle of the treasury curve came up a little bit. The long end, which is where we have our dollars betted on, the 20-year and the 30-year bond. In the middle, we call it the notes, and the front, we call it the bills. But you can see it worked. They've been pumping about $320 billion total into that front end of the yield curve. And sure enough, they were able to drag that rate right back down and somewhat fix the yield curve. Now you can see just from a general perspective that the long end really needs to catch up to the front end. It is way out of whack. And that's the distortion we can see when you pump $320 billion of funny money into the front end. And so here's where the banks are now kind of in a bad spot is if we look up here, the blue and the orange, the light blue and the orange are now a huge chunk of their portfolio, and they're down on it. And guess what? JP Morgan does not like to lose on its bond purchases from an exploding deficit from the government. And what's interesting is they've been allowing, it's not like there hasn't been a demand where they couldn't go flip these bonds because the government was issuing them at a rate that they can immediately flip for a profit. So they've been hoarding onto these bond positions, and their portfolio has grown by 50% in the bond portfolio. So there's a whole lot of reason for this front end of the curve to come down significantly. And so let's go look at where this yield was back in August when the trade talks broke down. So you can see if we just went back to where the yield curve was on the 30-year and the 20-year back in August when the first fear of the trade war breaking down occurred. Let's look at where the TLT was at that period. Boy, that SPY is not holding on to that gain at all. Look at that, 315. Okay, so just to get back to August levels, we have a $10 move. And so if we were to sell a call option and try to pick up, like 18, 20 cents, we might be missing out on multiple dollars. Now that run up could potentially take at least a month or two. So our expiration currently is we own the 138 put expiring on January 10th. So really we have nothing to lose at this point. Our maximum loss on this position is approximately 1%, a little bit over that. But our potential return is upwards of 8 to 10% in the next few months. So again, the TLT is the exact opposite behavior of the SPY. As you can see, most of the time you got red lines. So it's selling off, slowly bleeding into your account. And then it spikes rapidly. And it's done that like clockwork. So we've got the biggest banks in the world, JP Morgan, most connected to the Federal Reserve. These guys take turns managing the bank, then they go work as the treasury at the government, and then they go retire over at the Fed. So it's a circle jerk in that regard. So yeah, I'm absolutely expecting TLT has to go higher. And we'll talk about the big picture why most likely Brent's back. Hey, Brent, how's it going? I think he's made it to 3 or 4 in a row. So good for you. Also, if you're joining in live and your name is just guest, we do have a bonus. If you do speak up either in the chat, in fact, you'll have to, if you came in as a guest user, post your email in the chat box and communicate with us during this presentation, and we'll actually throw in a free week extension to your trial. Okay, so yeah, you can see the clear path of the TLT is higher, and we'll look at our presentation as to why on earth does a TLT keep climbing higher and higher while debt is at record levels. Without the forces of the Fed, of course, I'd suspect the TLT would tank tomorrow. Probably much, back down to these levels way back here. Okay, so let me pull up today's trade alert, walk you guys through it, and then we'll go through a presentation. Now, any questions out there just in general before I get going? Okay. We got some more people in here. Connell Cohen, welcome. So we've got 17 people live. Thanks for joining us. I'm going to start off by reviewing today's trade alert. Then I'll hop into the top news, and then we'll look at the yield curve probably for a little bit in more detail. And then I'll jump into the big picture in terms of how I think these markets are going to react and what we might expect for the next 12 to 24 months. Okay, so the news, we were up on almost every position yesterday with the Fed removing one dot plot from potential rate hikes next year. It's pretty clear they're not going to hike rates. We already knew that. If you read their 18-page FOMC minutes last month, it's 18 pages of great insights for sure. But all they're talking about is how they're going to slowly deal with hitting 0% interest rates. And how is the bond market going to react to that? So that's why we can easily predict the future path of the TLT in the long run. Now, sure, with trade deal potential, that's a short-term negative for bonds and a big plus for stocks. Now, I'm curious why stocks are not hanging on to that level right now. Let's just look back one more time. Okay, so it's barely hanging on to that 316. Our trade alert yesterday, if you remember, was to sell the 316 call. And so this is a good question. I had a bunch of people call me up, say, hey, should I close my call position out? And the answer is absolutely not. We do not want to touch that call option until very close to expiration because of the $2 potential profit per share on that trade. Even when we were way up at 317, just a little while ago, we'd only picked up $1.25 of that profit. So a lot of our profit, if we do go above our call strike, is going to be generated by holding on to it and letting the time premium erode. So we'll look at each position one by one and walk you through it. But bottom line is absolutely under no circumstances will I ever touch a position outside of our trading day and trading time. Not only is it not in our best interest 99% of the time, it's completely unnecessary and doesn't take advantage of letting the time premium erode, which equals cash in our portfolio. Okay, so let's just go from head to toe on today's trade, and we'll work our way down. We had another person join. Ash, welcome. If you have a mic, we'd love to hear from you. Okay, guys, I'm going to go into the trade doc first. Okay, so the first part of the trade is obviously to get out of the last week's trade. So you're always going to be buying to close your call and selling to close your put. In this case, the puts are worth a lot more than a penny, so we don't need to allow them to expire worthless. On the other end, you do want to buy to close your call, even though it's worth probably a penny right now. Now, the next step is to buy to open the 138 TLT put and to buy to open the 28 GDX put. And we're going to give ourselves an entire month. The reason why is it would be much more expensive to buy this put option every week than to just purchase it one time today. So let's go to the results. Our put option kicked in today. 138, so it did reduce some of the losses on the TLT. Now, this is for sure not what we wanted this morning. We were up throughout all of yesterday. In fact, we've been teased with the TLT. It's dying to jump higher. We've seen open profits on the TLT, but then we get positive trade talk. And so I do think Trump wants to try to not escalate until he gets through this impeachment process. That's what I'm trying to read between the lines. Peter Navarro's out pushing he has some pin name where he sends documents to everybody at the White House. He wants tariffs to go up. I'm sure Lighthizer pissed. So we'll see. I'll take a better look at the trade talk in a minute when we go into the news. Bottom line for auditing the current trade, the TLT traded from 139.08 to 137.06. And this gave us a net result of $1.46 loss per share. So we paid 60 cents for our option caller. And that option caller made its money today. So we did get out of the option collar for $1.16, reducing the potential loss on this trade by about 30%. So it didn't completely protect us from the downside. And that's because we had collected very little money selling that 138 call. And again, or rather that 143 put. And again, that's because I don't want to shortchange ourselves on the TLT. And once we do look at the chart one more time on TLT, it behaves just about the exact opposite of the SPY. Well, the SPY likes to slowly go up and then has vicious sell-offs. The TLT in general is mostly going down and then has vicious moves to the upside. And again, we'll look at the relationship between the TLT and the SPY. Most large hedge funds rely on this relationship, but the problem is this only works until we get to 0% rates, and then you get a big reset. And we'll take a look at that. Okay, GDX was a similar setup, but we had a very tight option collar. TLT can move up with just a little bit of fear and then just understanding the big problem of the bond market. Gold will most likely have a longer time to run up than the bond market. And so we've seen less downside move today on gold because we had both the Fed and the ECB signaling that not only do they see inflation coming, they want higher levels of inflation. So gold's your ultimate inflation hedge. Let's see, I think we have a question in the Q&A box. Okay, so guest says, so we just want to put protection at 138. We expect upside pressure, correct? And okay, so yeah, so the question is, we're expecting big upside in gold and bonds, correct? Why so far out on the expiration? Just to save money. We can essentially buy this put option one time today and then sit on it for a full month now and save a considerable amount of money on that downside protection. Now, if we were at the top band of the GDX and the TLT, I'd be trading it completely different, but we're not. We're basically at a 3 or 4 month pullback in bonds and gold. And so I expect that we're going to have a sharp rally, and I don't want to cut ourselves short or spend too much money on the puts. We can make one purchase today on that put and now sit back on this position. Now, for new folks joining in, they'll just jump into the same put we are in. So every Thursday now we'll review the position, but you're really going to have no action until I think we have screamed way too high, and then we want to start protecting it from a down move. So this will make our lives a little bit easier on the Thursday trade. So GDX is your gold miner ETF. Spot gold barely pulled back from this news today. And so GDX, it sold off a little bit. We were near an all-time or a maximum profit on this trade, which would be at 28.50 as of the close yesterday. But with the news this morning, I watched our profit pull back and posted the Trump tweet within a minute of it hitting. Because I was wondering, why is the SPY screaming so high? And it did it a little bit before he did the tweet. So there's definitely some insider trading there. Net result of this trade is that GDX went from 27.71 last Thursday, and closing out the position today, or rolling it over, is at 27.45. So we had sold the 28.50 call, and we bought the 27.50 put. The caller cost 16 cents and pulled a profit of 20 cents today, a net profit of 4 cents on the caller. The end result is we lost 22 cents a share on GDX on that trade. Now here we are at the SPY trade. This was when we were at 316.89. Our maximum profit on this trade from yesterday was approximately $2 per share, or $200 a contract. And you can see we've only realized $1.25 of that profit so far. So we actually don't want to be closing out those call options when it's in the money. We want to wait until as close to the expiration time as possible. So for us, we've decided to trade at noon Eastern as a very easy point where our entire group can meet up and place the trade. So I would assume that as long as we're above 316, we'll get very close to that $2 max profit. Now it is pulling back a little bit today, but overall, we're set up to do very well with the SPY trade tomorrow. Now, emerging markets has a very neat setup for us, and we've talked about this, is if we can get assigned, that's very good if we're betting down. So let's just look at the potential for this trade. We entered this trade when emerging markets was at $43 a share. And currently, at least when I took the screenshot, we'll have to check, it was at $44.23. So there's a potential to get exercised on the long portion of the trade. We sold that 41 call, and it did push up at least $1.23 at one point. So if anyone exercised their right on that call option, that'd actually be great for us, because that means we will get the entire premium we collected from selling the call option, which will generate a small profit, about $1.20 on that part of the trade. Now, we did purchase a put option for about $2. Let me go ahead and pull up in that trade. Oops. So the best outcome when we're betting down on an asset is actually for the, and this is what we call our inverted option caller. The best outcome is actually for the trade to go against us to get assigned, because that allows us to capture the long profit that's built into the trade, and then for the asset to tank by the expiration period. So for us, we're going to be managing this position on Tuesday. So if we wake up tomorrow assigned, let's just do the math. We agreed to sell our shares for $41 a share, and the trading price was at 43. So we collected 206. So that's about a break even. We have 4 cents of profit on the long portion of the trade. But what did we do with that income? Well, we went and turned it into a long put at the 42 strike. So if we get some bad news over the weekend or Monday, and emerging markets is selling off rapidly, we could be in a position where we've gotten out of the long side of the trade for a small profit, and now we're long this 30-cent put option. So that'd actually be perfectly fine. And let's just look at where emerging markets is at currently, see if it's realistic to be assigned today. So it's up, that in the money call option, that buyer is making some good money on that. There's a small chance if this hit 45, almost with certainty, we'd be able to collect all the option premium, be in cash, and still be long that put. Okay, so that's how we're currently positioned in this. This trade's down 18 cents, so we're up about $1.23 on the underlying. We collected $1.75 putting on this trade. But to close out that trade right now would cost $3.13. So this was a protective bet with 10% of our total portfolios in emerging markets. And we only stood to lose 0.5%. So, or half of a 0.005%. So half of 1% was our maximum loss on this trade. But if we were not assigned and emerging markets goes below 41 on Tuesday, we can make a minimum of 75 cents a share, or around 1.5% total return. If we end up assigned and we're just long that call, we can actually make substantially larger return. So this, again, is our trading plan. We're never going to be changing the underlying assets. We're just going to manipulate the option caller to predict the move in each trading period. So yesterday's SPY trade was a 316, 312 option caller. So we sold the 316 call and we bought the 312 put. And so that trade's working out very well for us. On Tuesday, we did the inverted option caller, and that was a very conservative trade, which we just reviewed. Very, very little to lose. With 10% of our portfolio, we're only risking 0.5%. So very, very little to lose on emerging markets trade. It was a super safe trade because I didn't know if we're going to delay the tariffs or not. Now, TLT and GDX we just reviewed. That's what we're playing today with the put option that's in the money. This essentially means we can bet up on the stock market with SPY and emerging markets as long as this narrative continues to be bullish. And so if we do get China to nod their head and accept this agreement, which is no contract, it's kind of a wish-wash sort of agreement here, then I would expect SPY and emerging markets to go up significantly higher from here. And we'll take a look at why that's the case. Now, on the side note, I don't think China wants to make Trump happy or make his life easy. In fact, they've proven that for 2 years now. So we'll see if they say this deal is good enough or if they say it's not, because they're not going to roll back all tariffs, which is what China's demanding. This move today did pull us back to a negative 0.6% return for December. And that's after we were finally getting into profitable. Let me take a look at the admin area. We got some new people joining in. Welcome, everyone. I have unmuted you, so if you have any questions, please feel free. Okay, guys, so yesterday everything was up. Bond market was traveling higher, signaling they want rate cuts. Stocks were going up. Gold was going up because of inflation fears. And then we got that Trump tweet. So that did give us a little bit of a loss from yesterday through today. Even though we're up on the SPY, we hit our maximum loss on the TLT and GDX. Now, luckily, we had paid a premium for our put options. So we had very little to risk compared to if we hadn't had that downside protection. We're still at a 14.29% return over the course of, we're going into the 13th month now. And our maximum drawdown over that period is 1%. So that's $1 of risk for a return of $14.29 currently over the course of 13 months. Now, if you're just trying to buy stocks, you have held on to volatility as great as 18% last December to sit on. I would have to calculate. I'm guessing we're up like 26% now. So you're risking around 80 cents to make $1 in the stocks. And I think there's a high degree of risk that if this trade talks don't continue to go positive, that it sells off very, very quickly. So we'll be carefully managing our SPY position and having that put option below. So ideally, what happens within the next month is that stocks tank, our put option kicks in, and our long TLT and GDX delivers a huge win for the portfolio. Okay, after that, we have our breakdown of each asset class return month by month. So you can look at individually how each portfolio is performed. Now, each individual portfolio does not have the high win rate that you get when you combine all the strategies. Year-to-date return on each of them is very close. So they've all had very similar returns, just at different times. The portfolio on Tuesday is engineered to take on a greater degree of risk because it's aiming for a greater degree of reward. And if we're going to do that, we're going to use a much smaller percentage of our portfolio. So we have 40% of our portfolio trading the SPY and only 10% trading emerging markets. Now, the same is true for the relationship between bonds and gold. We have 40% of our assets in the bond portfolio approximately, and 10% in gold. Now, the gold portfolio has also had cryptocurrencies in it, which we have been growing the position size as the Fed became more and more dovish. Don't forget, in December, they told us rate hikes were on autopilot and the quantitative tightening would be going on until September. They cut that off early. The infamous Powell pivot is what they made fun of him in February when he stopped all the hawkishness. And then we have had 3 rate cuts and the most quantitative easing in history in a 3-month period. Now, not in total, but they did wipe out an entire year of quantitative tightening in the last 3 months. And they're set to continue purchasing $60 billion of bonds per month for the next 6 months. Now, the key word yesterday in his speech was that they're willing to adapt what part of the yield curve they're purchasing. So that keyword adapt is all you really need to focus in on. Besides, okay, so the most important things is number 1, they did move one of the dot plots down so that there's almost no chance of a rate hike next year. And then 2, they used the word adapt where they're purchasing treasuries. So all the treasuries they purchased were, and so far, we're in the front end of the treasury curve. So these are treasuries ending with expiration or duration less than a year. And so that's how they say this is not quantitative easing because we're just relieving pressure on the money market. But now the expectation is they're going to come in and start purchasing the coupons. So we're talking about that long end of the treasury. And you can see the primary dealers who own the Federal Reserve. It's such a misleading thing to call it the Federal Reserve. They're owned by these big banks. So they own essentially the same thing as the TLT. TLT is just our easy proxy for poor people to have exposure to interest rate change, whereas these banks are sitting on $200 billion of US debt. And there's no end to the supply of debt. It's speeding up. It's not slowing down. For all the Trump talk about being the greatest economy in US history, well, you know, it's imagine you have a company and you go take out a huge credit card and start buying your own products. And then you go report these great earnings. But, you know, the bottom line is you just bought it from yourself by creating debt. So that's not really a very long-term strategy now, is it? Okay, so moving along. Again, our portfolio is designed to protect capital and to generate profits when the stock market is not. And so that's really what makes us stand out from the crowd. That's exactly how Ray Dalio, pretty much every big hedge fund with over $100 billion in assets, they didn't get there by trying to beat the stock market. They got there by providing return with less risk. And so that's exactly what we've accomplished. Does that mean we're going to hit our 1% target every single month? No, but it does mean I'm going to protect your capital at all costs. And so I do want to point out that it wasn't too long ago that Trump told us we have a guaranteed deal, not in October. That's when he first told us we have a deal, $50 billion of ag purchases. That's what he came out in a phase 1 deal. Like, what on earth? He'd been telling us we're not going to have anything but a great deal. So he continues to essentially backtrack and show somewhat of a cowardice from what he's been promising us. So in July is the first time he told us, at least recently, in recent memory, that we're going to have an agricultural purchase. By August, he lost his temper and we had no agricultural purchases. And that's when we had a big sell-off in stocks. But that was short-lived. By October, we were back into, by September, we were in trade talks, a lot of nasty rhetoric at the NATO meeting. We had Pence, who had delayed a speech, come out and really say some nasty things about China. And then surprise, you know what, we're not going to get a real trade deal that deals with intellectual property rights or subsidizing key industries. Like, for example, Huawei essentially has gone into the phone market and they're selling phones at a loss, which is putting tremendous pressure on Samsung and Apple. And they're doing this in a number of industries. And I did notice some new folks joining in. Gord Curry, welcome. A few new guests coming in. Ken H, welcome. We're up to 19 people live. Thanks for joining us live. There will be If you click the same link you used to join this webinar right now, if you wait about 2 or 3 hours and go back and click that link again, it'll replay this webinar for you automatically. So if you do want to replay it or catch any piece of this that you missed, feel free. So here we are, stocks surging to 317 on this supposed trade deal. So what's behind this trade deal? Let's go ahead and take a look. Okay, so this is the big picture. JP Morgan, Citi, Bank of America, Wells Fargo. Those are your main primary dealers. Goldman Sachs, they have been growing their treasury positions significantly. Okay, so here's the tweet that sent the market rocketing up this morning. Let's just see where we're at now. I'm kind of surprised it's not hanging on to that price today. Well, so we're sitting at 316. Getting very close to a big deal with China. They want it, and so do we. What a tweet. I love listening to the Long View. He runs like a $4 billion fund. He used to work for Ray Dalio. Has to feel pretty powerful to literally tweet the market to all-time highs. That was this morning. And I was watching the SPY scream higher before the tweet hit. So it's amazing how fast the market reacts to that, and if there's insiders trading on these tweets with insider knowledge. Okay, I'm glad to see President Trump saying this. China want it, and so do we, the U.S. Only when both sides want a deal can it be truly reached. Now, there's a lot of analysis that thinks there will not be a real trade deal until both sides have experienced a lot of pain. So from my perspective, it does look like Trump wants to not create chaos until this impeachment trial is over. That's my best read into it. I know his trade advisors are not going to like this news. Trump not removing tariffs, but cutting rates on existing ones. China demanded full removal. U.S. negotiators offer to cut existing tariff rates by up to 50% on 360 billion of Chinese imports. And this is for a pledge. So what I sat there and thought about that, they're not trying to get China to really agree to anything. They just want them to give their good word that they're going to purchase agricultural. What in the hell kind of deal is this? That was my reaction. It's not really a deal where China has to do anything. So it's almost like they've just signed their own deal without getting confirmation from China. So we'll see what China's response is to this. But my concern is that I don't think they want to give Trump a win. I don't think they want his policies continuing for another 5 years. And so my expectation is they're going to potentially remain firm that they won't even pledge to purchase anything until all tariffs are removed. So that would be very embarrassing for Trump. So we'll see. We'll just see how this plays out. Here is this note that Peter Navarro is supposedly the author of. He's got some pen name he's made up. I'm sure they're not happy about his tweet this morning. U.S. President Donald Trump is expected to meet with top trade advisors on Thursday to discuss planned December 15th tariff on some $160 billion in Chinese goods. 3 sources familiar with the plan said, as markets braced for potential negative impacts. It was very interesting all week. We're used to having Larry Kudlow come on TV and tell us trade deal is an inch away, a short stroke, a quick toss. They got all sorts of nicknames for it. But that had gone quiet for the last several days. And all we really had were a few hawkish trade advisors popping online to essentially tell us that they don't know about the tariffs being removed and that they most likely would go forward. So we're still not out of the clear yet. Many had expected the 2 sides to reach a deal ahead of the December 15th tariffs, but that prospect now appeared unlikely. The question now is whether Washington will delay the tariffs or let them take effect. So China may just drag their feet and do nothing over the weekend and continue to make Trump look weak. Real Donald Trump said that China and US are getting very close to a deal, but this could be another trick to boost stock markets. China wants to see real actions, not just words, to show sincerity, just as rolling back tariffs. Mirror image of last year. The Fed was hiking and Trump was beating them into submission with tariff threats. Yesterday, they dropped a rate hike from forward guidance, and today he follows up by walking back tariffs. You all know the market response, although it does seem short-lived so far. Rabobank, the FOMC, will have to cut rates all the way back to zero before the end of 2020. In short, enjoy the Christmas break because you will need it. Now, I don't know about that timeline. Of course, they've got a lot of money to be doing this analysis. In the long run, I do agree that we either face a government that cannot be funded, at least at decent interest rates, or the Fed has to continue to manipulate the bond market by cutting rates and driving the value of bonds up. And in fact, when we do look at this picture at the top, it would be quite a shock for the four largest banks in US, who are essentially the owners of the Federal Reserve, to be sitting on a massive loss in their treasury position for a very long period of time. Is it possible? Sure. Kyle Bass must be pretty upset this morning. And I'm glad we've still been patient in putting our trade on against the Chinese currency and the Hong Kong dollar. And this is exactly what I was worried about. But rest assured, any tightening in the Hong Kong dollar or in the Chinese currency will be a better entry point for us to go short those two currencies. So if you are a boot camp member, then our patience is paying off at this point. Hong Kong strengthened by like 20 basis, like 2 cents overnight. A goodwill gesture for trade talks. Chinese buyers have signed deals to buy 585,000 tons of U.S. soybeans. This is to feed the pigs they have left, which they've lost 80% of their pig herd, probably from the massive pollution. I just saw some pictures from space of China. It is the dirtiest of all the countries by far. And we've seen them pull this. They go out and they buy some agricultural products to get Trump thinking that they're really serious about agricultural products. And then we try to get them to agree to some sort of real deal, and they won't do it. So this has been the path of the trade talks for the past 2 years now. Little bit of positive data out of China, although it's hard to know if it's legitimate or not. They actually target certain GDP levels, and so they go calculate what they need to flip real estate. They go from the government, which is community proper real estate. They get the right from the province to flip it to a construction developer. Construction developer then goes and sells it to local Chinese, who get easy loans from the Bank of China. They have grown their currency supply just massively. So they have 212 trillion yuan, and they claim that 7 yuan are worth $1, or in other words, that their money is worth $30 trillion. Yet the currency volume for China is really just between China and Hong Kong. Something like 75% of all their trading volume is just back and forth with themselves. So nobody wants that currency. They have extremely strict capital controls that do not let the money flood out of China. It is grossly overvalued. And now they've essentially proven that it's not profitable to build ghost cities. They're barely able to keep Shanghai fully occupied, much less all of these other mega cities they've built. They've got at least 10 huge cities the size of New York that are just sitting there getting dusty. And you can find lots of videos on YouTube of different foreigners who come in there. It's a new thing, I guess. They like to get on their bikes and ride through China and blog about it. These are not finance people, and they're going through these mansions that weren't fully built, just completely evacuated. And really, this slowdown began in 2005. 2010 was a huge hit to their economy, and they've never recovered since. Their GDP growth crashed from always being double digit since 2010, and now it looks like it's on a sharp decline. iPhone sales dropped significantly in China. The big word is that they're getting very nationalistic in China. You wouldn't believe this, but they actually have a phone app that you have to open every day to get the message from their leader. And there's a quiz. And if you don't get the quiz correct, it's going to hurt your social score. So the people buying the construction in China are just your normal Joe who's getting a loan from the Bank of China. And now they're on their second and third home purchases. But these homes, unlike in America, nobody's living in them. There's no income. They're just concrete blocks. And there's 50 million houses that are uninhabited, purchased by the retail consumers in China. They're now on their third home purchase. And so that's how they've had this great GDP growth, is they just sell real estate to the Chinese people who aren't allowed to purchase anything else. It's the only investment scheme they have. And it worked until it stopped. And the problem is you don't make money building empty cities. You don't make money building empty houses that are never purchased or rented. And you don't make money building $5 billion bridges that a handful of people will travel on. You don't make money building a $22 billion airport right down the road from your already not fully maximized airport. So we saw the same thing happening in Japan. And Japan chose to protect their currency and their bond market at all costs, and that they had no intentions to continue their expansion. And you think about it, they live on a little island. So that made sense for their export-based economy, and they've turned and made their currency really their best asset, buying up every financial product under the sun with every penny they make. So they protect the value of their currency at all costs, and that cost was their real estate market has crashed, and their stock market has crashed for 30 years without ever getting back anywhere near the all-time highs. In fact, at one point, they were valuing Tokyo as more than all of California, and that was with Silicon Valley. U.S. Agricultural Secretary says China did commit to buy up to $50 billion in U.S. agricultural products, but part of the problem is they won't commit in a contract. Why on earth won't they commit in a contract? Now, this is an interesting move and something that Jim Rogers was somewhat predicting, although his prediction was Shanghai, not Macau. Chinese President Xi will visit Macau next week to announce a raft of new policies aimed at diversifying the city's casino-dependent economy into a financial center. So it looks like they're preparing a backup plan to get out of Hong Kong, which is costing them an absolute fortune to keep their currency peg up. And so we've seen the fastest rise in real estate prices and the highest cost per square foot in the world in Hong Kong. And now all the economic problems for Hong Kong are coming full steam ahead. Here's Kyle Bass. Hong Kong's banks are entering a full banking crisis over the next 12 to 18 months. Given the leverage in the private sector banks, and Hong Kong is going to have its hands full. Okay, now we're going a little bit back into history, like 12 hours ago. This is before Trump came out with his surprise tweet. And you might argue that he's just trying to get the SPY as high as possible before they do escalate. You know, this might be a bluff on Trump trying to prove the Chinese are just not willing to budge whatsoever. And so perhaps this is just setting up the stocks to get as high as they can so that the banks can protect the stock market. It's easier to protect it if it's crashing from a higher level than a lower level, I would assume. And again, they're maxed out on treasuries. So they really, the banks want those bond yields to go down so they can flip them to the Fed for a profit. And so to get that, we need a little bit of a crisis. Okay, so here's a communist Twitter account. Impose tariffs, China will surely retaliate. Such a trade war escalation scenario has been played several times. Washington won't be so naive to still believe it can crush China, will it? A trade war that doesn't result in a trade deal will only be completely denied by history. Wow, so they really want all tariffs removed. HSBC's chief risk officer abruptly quits. All of the signs are here. Banks begging for new deposits, GDP collapsing, Chinese government bullying sell-side research to avoid writing about these things. And so the big deal about HSBC, a big European bank, supposedly they were managing the conversion rate for CNH, that's Chinese offshore yuan, and they had been using a lot of futures contracts to bet that the dollar would go down against CNH. The exact opposite occurred. And so there's been a lot of people getting fired at HSBC, and supposedly they've abandoned trying to protect the Chinese currency. Survey found 48% of Midwest voters approve of Trump's handling of trade issues, while 52% disapprove. I can assure you at least 80% of Chinese people support tough countermeasures in response to U.S. trade pressure. They believe Chinese government is protecting their interests. So China's got some trouble. 4.5% inflation on food is a big problem for China. And at the same time, they're finding deflating prices in their manufacturing sector. So things are not looking so hot for your average Chinese citizen who's been used to their income slowly growing. So at around 11,000 a year is your average income, you're paying a 70% tax to the Chinese Communist government on every penny you make. And now you're finding that real estate rent costs are going sky high and food costs are rocketing higher. So that's not good. ECB says inflation's coming, just nice and slow. Gold market really liked that. Fed had something similar to say. Now we did see a drop in PPI, but a spike in CPI. So these are the metrics that the Fed supposedly would use to hike rates, but they've made it quite clear they have no intention of hiking rates. And in fact, all they really talk about is how do we deal with the bond market freaking out when they don't think that they can hold those bonds for a profit and flip it to the Fed. Because if they get to zero, then there's really no more room for yields to go lower. And in that respect, your value of your bond's not going to go up. So the Fed has totally distorted markets. So everybody's buying bonds, hoping they can flip it to a central bank for a profit and not to generate a yield. And if there is a fear in the credit market, there's trillions and $266 trillion sitting in sovereign debt at this point in time, 14 trillion in negative yielding debt. So that debt is really at risk with any kind of interest rate hikes. So inflation fears are a big problem. Okay, that's a wrap of the news over the day. Let's go ahead and open up for questions now. Before I go into okay, real quick, here's our yield curve. So this was before the emergency meeting when the yield curve inverted. And so the Fed came in with $320 billion in stimulus or quantitative easing, which they call not QE. And you can see they pumped all that money into the front end of the curve. So they were able to get these yields down. But you can tell the long end is way out of whack, way too high relative to the rest of the curve. And that's where our TLT sits. So if this comes back down to these levels, we have at least a $10 rise on the TLT. Now, if this were to flatten and this were to head even lower, the potential run up on the TL is just massive. So that's why our trade setup right now is no call option sold. We were able to weather 4 months with this essential rise in yields, which was negative on the TLT. And my expectation is now from the keyword adapt, they're talking about adapting where they make their purchases And then we can once again look at their partner in crime. Where have they put their bet? In that long end of the treasury. So I am totally expecting for this to play out in a very significant way for our portfolio. Okay, so that is where we're looking at with the yield curve. Let's go ahead and jump over to our big presentation. But first, let's open up for questions.
If you don't own the TLT stock, do you need to buy that with the put or just buy the put?
No, yeah, the put protects you to the downside. So we're actually expecting the put to lose money in the long run, but to reduce our volatility. So this setup allows us to pay a little bit of a loss currently. And if let's say China comes out and says, you know what, we'll take your deal, Trump. You cut half those tariffs. You don't do the December tariffs. And we promise, we pinky swear, we'll buy a whole bunch of pork and soybeans from you. And maybe we'll even buy some oil. Okay, if that happens, and we'll look at in our presentation, if that were to happen, I'd expect TLT and GDX, maybe not as much GDX at this point because of this inflation creeping in and all the quantitative easing. But certainly we could see some downside risk in the TLT if there's good news in the next 2 weeks that China is pledging, that they're giving them a gentleman's handshake or a pinky swear, whatever you want to call it, for this trade truce or at least a break. Okay, so this setup, we're buying an in-the-money put, and that essentially means after you've paid that premium for your put option, your loss is set. You can't lose any more money. But if the TLT goes up greater than the cost of our put option, we're in the money. So if I think that, let's just review that trade one more time.
So, and William, to answer your question, yes, you absolutely will want to own the underlying shares of TLT as well.
Yeah. So in this trade setup, we really need the TLT. So we bought that 138 put, which is $1 in the money. So we're picking up $1 profit on that, but we're paying $2.40. So essentially we're down. We're basically jumping into $1.40 loss in that position immediately. But if the TLT goes to 130 to 125 to whatever, we don't lose a penny. We're taking our loss right now at this point in time. If TLT goes up $1.40, we're now in the money. And my expectation is TLT could go up $5 to $10 at a minimum in the next several months. And in the next several years, I believe we'll travel closer to 180. And in our presentation, I'll explain why. But essentially, U.S. government will not be funded if rates don't keep going lower. So unless we thought the banks were trying to create some sort of coup against Trump and wanted to crash the stock market, if the TLT goes much lower than it is now, say to like 120, 110, your 20-year, 30-year yield is going to spike above 3%. And banks and all investors around the world are going to get out of stocks and go take that risk-free return. Because think about it, if inflation is supposed to be 2% and it's been less than that, and I can make 3% a year for 20, 30 years, I'm going to leverage into that trade and capture that gain. And then also, so that's a hell of a deal because not only can you make money from the coupon for 30 years, if there is a real global slowdown, which quite frankly, that's the case in China without doubt, then I can also let my bonds appreciate and flip them at any point for a huge profit. So bottom line, if this TLT goes towards 110 or 120, it's going to cause stocks to sell off massively and a huge flood of money to head into the bond market. So I don't think that's going to be the case. And obviously, neither does JP Morgan, Goldman Sachs, Citi, Bank of America, Wells Fargo. Otherwise, they wouldn't have a record level of treasuries that they're hoarding. And it's not like they can't sell those all year. TLT's been flying up. They've actually been able to buy it from the government. They have exclusive rights to purchase from the government, and then they could go flip it in the open market for a profit, but they're not. So you got to ask yourself, why would they do that? So yeah, you want to own the asset and then buy the put. You're going to essentially lock in your maximum loss today by buying that in the money put. And then if there's any kind of danger between now and January 10th, this will be how we generate a large profit in our portfolio. Meanwhile, we got to play the narrative on the SPY. So we'll continue betting up on the SPY. Let me go into to our presentation here, and this will explain why we're being bullish on all these assets right now. Now, real quick, are there any other questions out there?
Yeah, and team, just please feel free to jump in, and just kind of wanted to comment and piggyback on what Jason's saying here. So really, Jason's showing you all of the things that he monitors and that we monitor, right, 24/7, 365, to make sure you all are positioned properly. But as far as what you need to have in your portfolio to be completely balanced in the current allocation, it's just 4 ETFs, right? And then we're going to use options to just add another layer of security. So we take a really, really defensive balance to the portfolio, and then we just add options to it. And we trade at noon Eastern Standard. So just to kind of piggyback on what Jason's saying and just, how this all correlates to you. But Jason's showing you exactly what we're looking at all times, okay, and why we look at it.
Okay, guys, let me show you how we're kind of positioned and what we're really focusing on, and that's the central banks. So yeah, we're not going to change underlying assets. We can just use the option market to pick the direction. I'm going to skip through all the stats about the program. Let's go right to the good stuff. Okay, so I really have 3 trading plans preset based on the market conditions. And so essentially we have a de-escalating trade war, we have an escalating trade war, and we have an up in the air trade war. Now the caveat to this is we're assuming one critical thing, and that's the central bank policy. So we're counting that interest rates will remain low right now at 1.75 at the federal funds rate. Money's just about free. So that's creating a lot of poor investments. If you don't have to pay much interest, you'll make all sorts of crazy business decisions. So the expectation is that rates will not only stay low, that they will head lower. And this is due to low levels of inflation. Now, the funny thing about low levels of inflation is that because of globalization, we've created an environment where having low interest rates actually creates low inflation. Why? Well, if you can borrow for almost free, Microsoft can actually issue bonds in Europe where they have negative rates and get paid to borrow money. Okay? Same thing for Netflix, Uber. These companies have a business model where they're incentivized, and whether they like it or not, they're competing with other companies who have the same incentive. And that is essentially to borrow as much as they can and not worry about profits. They're worried about market share. So how do you get market share early on? You sell your goods at a loss. So we got all these, the Fed's not stupid. They know exactly what's happening. Corporate debt's at $3 trillion. It's ridiculous. But this is a self-fulfilling cycle. If I can get cheap money and I have to compete with someone else who also can get cheap money, how do I get market share? Well, I've got to provide a better product at a lower cost. And so we've been living in this period where debt is getting out of control and we've had low inflation. So there's no pressure on the central banks at this point in time to hike interest rates. And they have actually told us, even if there is high levels of inflation, they're still not going to hike rates. So that's the single most important thing to understand about how we design our trading plan. So assuming that we have low rates, low inflation, and quantitative easing, which we know they've committed to $60 billion a month until mid-2020. JP Morgan's been threatening that they want more than that and that there's going to be an event. So we've had a lot of rumors spreading that there is a risk event happening in the near future. And when you look at the assets that JP Morgan's loading up on, it's not equities, it is bonds. So we got to be very cautious at this point in time. Okay, so if the trade war is up in the air, we're essentially long all of our assets. So I just want you to note the plus sign by SPY, emerging market, TLT, and then the sideways sign on GDX. That means I'm going to design our trade to benefit from all assets traveling higher. But on gold, I'm actually going to be relatively tight. So if there's not a panic, I'm not going to be too bullish on gold yet. And the main panic for gold is a little different than bonds. Bonds are more concerned about GDP growth. Gold is more concerned, is more beneficial from inflation concerns. So they're slightly different. But the way we've organized this, SPY and emerging markets have a very close relationship. They're not exactly correlated, but they have a very high degree of correlation. Bonds and gold tend to have a high level of correlation, but they do break parts at a critical point as well, which we'll look at. So right now, with the trade war up in the air, which is what I would say we have, you saw the reaction today. What happened when we got something positive about a de-escalation in the trade war? Immediate reaction, like clockwork. Stocks flew up, bonds crashed. Gold didn't really. Gold is actually reacting to that inflation headline yesterday, but it did sell off a little bit. Okay, now what happens when the trade war escalates? Like clockwork, you can bet your money on it. Stocks tank, bonds and gold go up. And what have we seen for the better part of the year? Well, we've only had a few tiny moments where the trade war really escalated. It's more like a cat fight, kind of like throwing a egg at the other person's car and then sitting back to see what they're going to do. This hasn't really gone into full-blown fight. Okay, so most of this year has been up in the air with a few instances of the trade war escalating, which were short-lived, and a few instances of the trade war de-escalating, which were also short-lived. So most of this year, we've seen all four of these assets bubble up. Why? Low interest rates, low inflation, quantitative easing. We're in a bubble. Now, if the trade war were to actually escalate, we know exactly what to do. We're not going to sell the SPY. We're not going to sell emerging markets. We're going to make more money than we normally do with the inverted option collar. We'll take a look at that in a minute. What are we going to do if it really de-escalates? Well, we're already ready for that. So we bought this is where we're at today. Okay, now remember, last Tuesday, Trump said we may not do a deal until after the election. A week before that, he says, guess what, small farmers, I've got a big bailout coming for you. So I don't think we're out of the waters yet by any stretch, but we're currently prepared for this. Our SPY is set up to generate a profit to the upside. Emerging markets wasn't yet, and that's because I wanted to get past Sunday, the tariff deadline. But I didn't set us up to lose but 0.5% on 10% of our portfolio if that lost. So we have very, very little to lose on emerging markets if the market does go higher come Tuesday. Now, if China comes out and says, all right, we take your deal, Trump, we're going to be doing exactly what you see here. And we're already positioned for that. We bought the in-the-money put on TLT and GDX. So we've essentially already committed to the maximum loss on that position as of today. We will not lose another penny on TLT or GDX from here on out if the trade war de-escalates. So once again, because we didn't sell the call option and we bought the in-the-money put, we now have 1 month of downside protection on TLT and GDX. And our maximum loss is already in the books on that position. So at this point, we're going to be allowing the TLT and GDX to sit there until something bad happens and bet up on SPY and emerging markets. Now, if China really says, all right, we're game, where's our next target? I think SPY can go much higher. So we're already at nose bleeding levels, but that just doesn't matter. This is not a world where people are worrying about generating profits. This is a world of money flows. And right now money is essentially free, and it's potentially going to get even cheaper. So the only thing that would really make me concerned about the SPY and emerging markets having a sell-off would be if the yield on the long end of the treasury got so attractive that banks just couldn't turn it down. And again, that would be a short-term sell-off. So we could potentially see SPY go well above 330 at a minimum in the next several months if this trade deal really, truly de-escalates. So we saw Trump de-escalate. Will we see China de-escalate? If they do not de-escalate, and this should happen soon, I mean, is potentially by Sunday, we should have confirmation that China is going to accept this deal or not. If they don't, then we're already set. So our TLT and GDX are set to skyrocket. We won't miss out on a penny. Our put option will lose value, but essentially we just need about $1.50 pop on the TLT to be in the money on that trade. And the upside, just go back to August, just back to August. That's $10 run up in the TLT. Okay. Now, if we go back to up in the air, all these assets just bubble up by the big macro view. And we'll look at the bond market. I think that's one that confuses most people. Let's review the 3 trade setups. So if we have the plus sign next to the SPY or the TLT, we're going to do the bullish loose option caller. That's what we're in currently on the SPY. And so whatever strike we sell the call option at, that's where we're going to want to hit at least on the SPY. So we don't care if it goes above that level. We just know this is all you really need to know is whatever strike you sell your call option, you want that to go above that. That means you're going to hit your maximum profit. And if someone else makes a little extra money from the trade, who cares? Okay, so we sold let's see where we're at today. Let's see if we're still at that max profit. So right now we're at our max profit. Your call option will show its lost money. The put option will show its lost money. That's the way the trade's designed. So in a bullish, loose option caller, profits generated on the underlying asset. So currently we're at our max profit, but we can't realize that max profit until tomorrow when the time premium has eroded in that short call. So if you're worrying about seeing a loss in your short call or your long put, don't. That's the way that trade is designed. Okay, let's go back to, okay, now here's a trade where we would expect the asset to trade flat. Now, if it goes up, great. We still get our maximum profit. But in this setup with a tight option caller, we severely limit our downside risk. So as soon as I think, let's just say the trade deal is accepted by China, and all of a sudden SPY flies to like 330 and TLT goes much lower. Your 20-year, 30-year yield suddenly is well above inflation expectations. All right, well, we're going to lock in those profits on the SPY at 330 with something like this. And that allows us to generate profits if we just trade flat or up. But if it tanks, we have very limited downside risk, only 93 cents a share. Now, remember, we have twice as many shares of the TLT versus the SPY. So if we can only lose $1 on the SPY, but we pick up, let's say, just $1 on the TLT, net, we've doubled our money overall because we lost $1 on the SPY and we picked up $2 on the TLT. Now, this is a setup where we can make the most money, but it is the rarest to occur. And this is where we do the bearish inverted option caller. So I actually want to see a catalyst before I will put on one of these trades. The market's just not engineered for this to happen very often. Otherwise, the entire financial system breaks down. So very rarely do we put on these trades, but they can be highly profitable. And in fact, if you note, the last 3 trades, we had a 1-to-1 risk to reward ratio betting up. The second you bet down, option market knows that's against your probabilities. And you can see we get a 2-to-1 risk to reward ratio. In fact, In this trade setup, it can even go against us. So we're betting down, but you can note right here in the middle, this can go up and we still break even. If it goes down, we get a 2-to-1 risk to reward ratio. This is accomplished by selling an in-the-money call and buying an in-the-money put. So the time's coming when we will be making out like a pig on this trade. It's just not yet. I will only issue these trades when there's a clear catalyst. Okay, so how do we design our trading thoughts? Well, really 3 big things. One, I want to know what the Fed's buying or selling, and specifically what part of the Treasury curve. So right now they're applying a lot of relief to the front end of the curve, and now the likelihood is they're going to start moving out in the curve, which would be very bullish for the TLT and for JP Morgan, who's loaded up on that long end. Okay, now if they're not purchasing assets, that's very negative for everything. In fact, look at what happened in 2018 when they tried to sell about $1 trillion of assets. Well, we had 98% of all assets globally lose money by the end of 2018. So they realized that's not going to work, and they had to do the Powell pivot. Next thing I want to focus on is, are they going to adjust the cost of money? Now, this is the chart that you should print out, put on your wall, and really focus on, because a lot of people I talk to really believe that they don't want to sell their stocks that they're up, 400% on, because they would rather just hold through the next recession. Might be a 50% drawdown, they think, in their head for a year, but then it will go much higher. So they don't want to realize the profits and pay their taxes. And so what I want to point out, and Paul Volcker is the one who made this possible for you guys. If you've made a lot of money over the past 40 years, this isn't really an 11-year business cycle. The bigger picture is that this is more like a 40-year business cycle. And we'll see how long they can keep it going with low interest rates. But the thing that will end it all is inflation, which is slowly moving up. But here you go. So this is the federal funds rate. And what's important to note is that every time we've gone into a recession, the Fed has been able to cut interest rates by over 5%. In some cases, 7%, 10%. And you can note they're cutting it less and less as the rates go lower and lower because they have less room. This time around, they can only cut rates by 1.75. That's where we're at right now. We started at 2.5. They're able to get them to 2.5 during Trump's term. So under Obama, they left rates at free. So we had the biggest waste of money in history from 2010 and 2015, handing out money essentially for free. Okay, and then we get Trump elected, markets rocketing higher, everything's looking good. So they said, all right, this is our chance. Let's get those rates higher so that when the next recession comes, we have some ammunition to fight it. That was short-lived, and they only got rates up 2.5%. We're already down to 1.75. And what are they going to do when we get to zero? That's the big question. That's what the Fed spends 100% of their time discussing. And they've got all sorts of plans. One is what Japan did. Japan decided to protect their currency and bond market at all costs and to allow their real estate and stock market to deflate. I don't know if that'll be our choice, but they certainly were talking about it. And the language was that they would cap yields on bonds. So if you've bought a bond and you realize that the inflation rate is greater than the yield, and you also realize that rates can't go any lower, what are you going to do with that bond? Are you going to sit there and make less than inflation for 10, 20 years? Probably not. Are you going to hold on to a bond that has less value? Probably not. You're probably going to have a whole lot of money flooding out of the bond market as we approach zero. So the big picture is that most likely we're going to repeat what happened from 1960 to 1980 to get this bond market back under control, to get all these zombie companies out of business or adopting their business model to actually be profitable. And we're going to see rates rise. Now, the timing on that's going to be fun. My expectation is to try to delay rate cuts every 3 to 4 months, maybe 6 months if they're lucky. And this could draw this out for another 2 years at maximum. Now, that's if the trade war does not escalate. Now, you got to bet the Chinese understand this just as well as the trade representatives in the US. So they're incentivized. They realize our strategy for keeping our stock market and bond market intact is going to have some severe issues the second we go to 0% rates, because now the expectation that you can buy your bond, hold it, and generate a profit is gone. So why on earth are you going to buy bonds that yield 1% or less if inflation target by the Fed is not just 2%, it's to overshoot it? They were even joking about 4% inflation in the Q&A yesterday. Now, they were just joking that, why would we talk about 4% inflation if we can't get 2? So the bond market has some trouble ahead. And what will the Fed do to protect the credit market? Now, what makes the Fed move even though they don't want to? Inflation. So that's the big concern. Are we seeing inflation around the world? Unfortunately, yes. China's inflation rate's at 4.5%. Maybe it's self-inflicted by placing tariffs on where they purchase food from. Maybe it's self-inflicted from pollution causing African swine flu, and they lost 80% of their pig herd. But in general, the bigger reason why is that they've printed 212 trillion yuan and then used that to loan it to your Chinese populace to buy 2, 3, 4 homes, which aren't even being lived in. They're not being rented out. They're just losing money. They spent a fortune building 50 million houses that are not being lived in, while they have 30 million people still living in dirt caves in China. They've got 10 cities the size of New York that are ghost cities. So the strategy is not turning into a profit for China. And now that money desperately wants to get out of their economy. Here's a look that I'm sure most of you who've been following me for a while have seen. This is SPY against the TLT. This is what most financial strategies rely on, is the relationship between the SPY and the TLT, or the bond market. And the basic idea is stocks sell off, money flies into bonds. Bonds sell off, money flies back into stocks. But overall, because we're continually dragging rates lower, they're both going up in unison. But what happens when you get to 0? Are we going to go to negative rates? That's the only thing that could make this extend beyond most likely 2 years. Now, what does Kudlow say they're trying to do to solve this problem? Well, their hope is that they can blow a bunch of money and get our GDP faster, our growth faster than our debt. So right now we're growing at 2% GDP, but it's costing us a growth of 6% in debt. So that is not sustainable. And that's the big picture why. As long as we spend more money than we make, the only way to keep this tied together is to continually lower those interest rates and make bond investors believe they can hold it for a profit and flip it to the central bank. So that's what's keeping this together right now. And that's why most likely we're not going to have something like the 90s or the 2000s where this is just a mid-cycle adjustment and there's lots of room ahead for further bull market. We're out of rope. We can't go any lower on those rates. Here's a look at the TLT again. It doesn't go up nice and smooth like the stocks. Now they really have the exact opposite. So in the SPY, you can see it mostly goes up until you have rare crashes. Bond market does exactly the opposite. And so that's why you want to be patient with the TLT to hit your big wins on it. This is just zooming in on certain points in time, showing the TLT against the SPY. And I just want you to note they go the opposite direction. So we shouldn't expect to hit a win on both at the exact same time. But overall, as long as the Federal Reserve can keep lowering rates, the big picture is they both go up together. Now, what happens when they run out of room to lower interest rates? And even during big stock market rallies like 2013 to 2015, you can see the bonds provided the protection, but they didn't really eat away at your profits. They both ended near with a profit. And here's the most recent scare. Stocks tanked at the end of 2018, and bonds went on a massive rally. And this is after being pushed down as the Federal Reserve was hiking rates. Now, gold, we play with the portfolio in either direction. I'm not a gold bug, happy to make money with it tanking. I just don't think it's going to tank anytime soon, because we realize the cost of allowing gold to tank would essentially mean we're going to let the credit market tank, which in turn would make government debt unsustainable. So either the government's not funded or rates go lower. It's really that simple. If rates are going lower and quantitative easing is ramping up, you want to own gold. And gold and bonds are somewhat correlated, but not always. And so we can see that most likely we'll see stocks and bonds crash before gold in this environment, and that'll mark the end of this 50-year cycle or 40-year cycle that we're currently in. Now, if spot gold is really expensive, towards 1,500 an ounce, I'd rather own the gold miners than spot gold. So we traded spot gold all year, and now we're in the miners. What's in the SPY? 500 companies, great dividends, and all your top tech and banks. So here's your big companies: Microsoft, Apple, Amazon, Facebook, Berkshire, Alphabet, JP Morgan. One share of the SPY is better than owning any specific company, because you remove yourself from business risk in that specific company. Emerging markets has 1,000 companies out in Asia, excluding Japanese companies. The big names are, and this does cover China, South Korea, Taiwan, India, Brazil, South Africa, Russia, Thailand, and Saudi Arabia. Biggest companies are most important are Alibaba and Tencent. We also got Taiwan Semiconductors, Samsung Electronics. Probably a loser in that one is China Construction, once we realize where that money is going. Naspers, insurance companies in China. China Mobile. China is growing rapidly. Asia has something like 2/3 of the population. So it certainly makes sense to have part of our portfolio long-term in that piece of the puzzle. But short-term, there could certainly be a lot of pain put on China to close a trade deal. Now, will this happen in 2020, or is this going to happen in 2021? Time will tell. GDX is a great ETF if you want exposure to gold miners. Instead of buying junior miners, I really recommend buying GDX. Most of the money to be made for gold mining is going to be achieved with these top companies who have access to capital to actually go mine the gold while they have time and then flip it to the central bank. So Newmont and Barrick are your two big dogs, where 20% of all assets in this fund head directly to. So if you own a gold miner and it's not on this list, they're probably not going to ever show a profit. They're just running investor relation ads and paying management. They're not mining gold. Now, I do want to throw out that if you call Dean and lock in your discount, you can get a free month in our $10,000 boot camp. That's a special webinar every other Tuesday. It has some more advanced trade alerts where we're going to be shorting Hong Kong dollar and the Chinese currency. We also put out some options on the VIX. And once we get towards that zero bound on the bond market, you better bet we're going to be ready to short the corporate bond market, probably the low end first, and then we'll work our way up the food chain. So call Dean at 505-322-7515 to upgrade your free trial. Okay, so we're moving along in the presentation now. When does the strategy break? Well, basically when rates rise, and that's typically because of inflation or deflation. And so if you think that the next crisis will be short-lived in 1 year, well, we just talked about why that's probably not the case. But going back through history, we can see there have been 15-year plus bear markets in the Dow. So 1965 through 1980, when we had runaway inflation and Paul Volcker had to hike rates all the way up to 20%, you lost money for 15 years. And if you had invested in stocks in 1965, now look at that. After World War II, man, stock market nearly quadrupled from 2,500 to almost 10,000. You probably thought at that point in time, the stock market and the US economy is invincible. But there's a whole lot of parallels. High levels of debt versus growth, social programs, just like we have right now, eating away at our budget, massive government deficits, a Cold War with Russia, low interest rates for too long. What happened? We had a 15-year bear market in stocks and bonds from 1965 to 1980. In fact, if you had bought the top of that 1965, which might just be the same as today, and you look back, all these little short little crashes, you were paid handsomely to hold your position and have faith until it didn't work. You would have had 30 years to get back to even on the Dow had you purchased stocks at 1965 with a buy and hold strategy. Same is true after 1930. So Germany was getting punished by everyone for World War I. Everybody wanted reparations. Germany couldn't afford it. They went broke trying to fight the war. Meanwhile, everybody's demanding so much money from them. It made their printing press go wild. They printed money to pay the debts. This created inflation, a lot like we're seeing in China right now. And eventually it spread worldwide and we had deflation. What's deflation? Well, if you think the value of your money will be worth more tomorrow than it is today, are you going to make any purchases? No, you're not. You're going to wait for your money to rise in value. So that's why the Fed wants this 2% inflation rate. They want prices to slowly go up, but not too fast. And they sure as heck don't want prices to go down, or at least the value of your money to increase. So that's how they keep the economic wheels greased, per se. And so World War I, we had inflation. You had a nice, nasty crash in the Dow. We get out of World War I. It's the ripping 20s. America became a gold hoarder. Pretty much all of the world had pushed all their gold to the U.S. I think we had 80% of all gold reserves. And our economy hadn't been hurt whatsoever. You got the roaring 20s, massive, massive misallocations of capital and skyrocketing stock market. Didn't last long. We got the worst crash in history from 5,000 down to something like 250, just a huge loss. And then we get out of World War II, and now you get all sorts of crazy government policy. The bottom line is they spent more money than they made. They wanted to help all the people who'd suffered. So we get lots of social nets, lots of government spending. And that worked until inflation came for quite some time. So we'll look at the history in more detail. Let's take a look at what I think is going to play out. I think by 2021, a crisis will hit the stock market. Okay, so maybe it happens sooner. Hell, it could happen Sunday if China doesn't shake Trump's hand with his new offer. We could be in crisis mode by next week. What happens if we get a crisis? Well, stocks sell off, bonds and gold go up. That's what we're positioned for currently. What's the Fed going to do? They're going to lower those rates rapidly, and they're going to expedite QE. And probably instead of buying the front end of the treasury, they're going to start buying the coupons, which is where JP Morgan has a huge position currently. So what happens if that all occurs? You know, timing is tough, but this could happen at any time. It could happen Sunday. Again, if China doesn't shake Trump's hand on this one, we might be ready for escalation by next week. Now, do I think Trump wants an escalation next week? No, I think he wants to get some agricultural purchases for the farmers and to kind of just push this into 2021 with the trade war. Is China going to give him that privilege? I don't know. I don't think so. We'll see. Okay, so we get a stock market scare. What's going to happen? Well, stocks will sell off for a while. Bonds are going to push up higher. That's what we're expecting currently, until we get towards zero rates. And that's when the bond market realizes, wait, why on earth am I buying bonds that yield less than 2% for 20, 30-year expirations? And we're doing massive quantitative easing and inflation is rising. That doesn't make any sense. So my expectation will be a knee-jerk reaction. Stocks bump right back up, and now it's the end game for the bond market. Now, how will the Fed react to this? They're talking about capping yields, which would still be the same thing as game over for bonds. The only thing that could keep bonds going a little further would be the discussion of negative interest rates. That's really all it has to discuss. And I don't think they're going to go that direction, but we'll see. So in this setup, with rising inflation, stocks get their last hurrah, gold gets its biggest pump, bonds are tanking, and now we have inflation sinking in. We have to stop the quantitative easing, and the Fed has no choice. They have to allow interest rates to go up to fight inflation. So you end up with that decade like you saw in 1965 through 1980, like you saw in 1930 through 1945, where you get a 10-year bear market in stocks, bonds, and gold. And so when the Fed has to raise interest rates, it's game over for all these barbell strategies where you're long stocks, long bonds. It won't work. So luckily for us, being a small trader, it's much easier to navigate these waters because we just go do the inverted option collar. Now, if you're trying to do this strategy with $140 billion like Ray Dalio has, good luck. You can't. There's not enough liquidity in the option market to do that. So that's what I think is coming. Now, what happens after you hike rates up really high? Well, a lot of companies go bankrupt because their business model no longer works. They can't borrow to create a loss. They have to borrow to create a profit. So if interest rates are 5, 10%, you're only going to borrow if you have a damn surefire way to make money. You're not going to be wasting a penny, and you get your big reset. So think of 1980 when Alan Greenspan takes the steering wheel and then essentially dropped interest rates for his entire career and created the biggest bubble of history. Well, that's what we could repeat, but we're probably at least 11 years away, maybe longer, before we've been able to reset the markets. And that's where we'd be long stocks and bonds again. But the only difference is we'd still be short gold. Okay, a quick look at inflation. We've been in this inflation heading lower and lower over time. And again, the cheaper we make the bond market with a global economy, we're seeing what the corporations do. They don't try to create a profit. They're incentivized to take over market share. To take over market share, you have to compete with obviously your competitors. And if you have access to free capital, we're not going to worry about profits today. We'll worry about making profits later on. So this is causing companies at a global scale to sell products at a loss. Think about Huawei. They went from a nobody to the top phone seller in the world in terms of total phones sold. And they've done it by selling phones at a massive loss. How can Samsung and Apple compete? It's difficult. They do have the edge on the processing chips, but the word is that they're catching up on that. Inflation's what will ruin the long strategy that our entire financial system's engineered to live with. And we can see over the course of history, when inflation does go up, the blue line, the Fed rarely hikes interest rates. So you can see they will pop that interest rate right above the inflation rate, and inflation goes right back down. But what does that cost us? It costs us a negative GDP. So our entire economy is based on growing our debt. And the second we stop growing our debt, corporations stop turning profits, and you get stock market and bond market shocks at the same time. The treasury rates can be predicted by predicting where the federal fund rate will go. Now, a lot of people like to say the bond market guides the Fed or vice versa. But I really think it's the Fed is really at the control of the interest rates and not the bond market. The bond market will predict what they think the Fed will do, but that doesn't mean the Fed is absolutely responding to where bond yields are. Now, my expectation again is that they must take rates to zero as slowly as possible to continue the business cycle. So we can look at their FOMC minutes and their every interview they do for the best hint. We can also look at inflation in other major economies as a warning sign. We're already getting warning signs in China, less so in Europe or America. So currently it does appear the path for the Fed is slowly but surely to zero. That means your TLT is going to go much higher before the game's up. Now, the scary part about this is the Fed is certainly overlooking many things that people actually have to pay money for, and they've calculated it out of the CPI. Main things are medical, college, and housing. And so as the government puts their hands on those different assets and backs them, we see massive inflation immediately. So Obama's administration essentially told the banks they're guaranteed the money on the college loans. So what happened immediately? Banks start giving everybody and their mom college loans, and colleges jack up the prices. That's one cost you can't bankrupt. Now, what's even scarier is if we do go back to the 1990 formula, interest rates should be at least 6%, and our inflation's at a safe, steady 5%. Not that that's safe, but at least it's not accelerating up. Right now, we're at 1.7 interest rate, so that's not good. That will continue to push inflation higher. If we go back to the 1980 formula, inflation looks much scarier. It's not just at 10%, it's in a clear uptrend. This is where you need Paul Volcker to step in and fix the real problem. Rates should probably be up about 12, 15%. Nobody wants to do that. No president wants to do that. No populace is going to vote for it. So what's most likely is they'll continue to cut rates and drag this along until they can't, until inflation's just in everyone's face. Now, what happens when you get super low unemployment? Well, now companies have to compete for labor. How do they compete for labor? They have to increase wages. What happens when you increase wages? Well, you better increase your prices. Otherwise, profit margins go down. So this low unemployment rate is applying more and more inflationary pressure. If we go through history, you can see this is the case. Here's inflation during World War I, high levels in inflation. Right after World War I, prices get under control. The 20s, you can see, have low inflation, and that's when you got one of the best stock markets in history. The Great Gatsby is I'm sure you guys have all read that book and watched the movie. But what happened by the end of that decade? Well, we tried to punish Germany and make them pay back for all the losses that the world had encountered, for millions of lives lost, tons of money. All of the gold reserves in Europe are now in America's hands. And slowly but surely, it worked its way across the globe. And we got deflation. People thought they better hold on to their money because they could get a better price in the future. So what happened in the stock market? Well, sure enough, while there's inflation, stocks are going down. While inflation's low, stocks go up. When you get deflation, it's far worse. Then that's when we got the worst crash in US history. And then we got a period of low inflation from 1945 through 1965. Inflation was pretty much under control. We have a few high prints, but overall, it's right in that 1% to 2% target range where you're not in a rush to make your purchase, but you're also not incentivized to wait. Now, what happens by 1966 through 1980? All of a sudden, all this money we'd printed, feeling great, just the same thought we have right now. Everything looks great, but it's more like, it's, again, you have your own company, you go open your own credit card, and then you go buy your own products, and then you say your GDP is great, but yet you have to pay interest on that loan, and you've just purchased stuff from yourself. It's not real growth. So really, what you want to see is growth that's greater than debt. That means you're effectively spending the money that you're loaning your economy. And eventually, it doesn't work. And you can see in 1965, we have the runaway inflation. What did the stock market do for 15 years? It tanked. Sure, you had a few bounces that might make you think the worst was over, but it wasn't. Here's what Paul Volcker did during that period. And I look at 1955, 1960. To me, that looks a hell of a lot like the housing bubble and now the current action, bouncing rates around zero until inflation came. And you can see he couldn't get inflation out his entire career, had to hike rates all the way up to 20%. Every single time he dropped rates, inflation came ripping right back. Now, what happened after we got to extreme interest rates? Well, 15 years of negative returns in stocks, bankrupted a whole lot of companies. You had the companies left over that actually make money. And here's what came next. We had inflation going down and we had interest rates going down. Alan Greenspan pumped up the biggest bubble of all time, Dow 2000 to Dow 18,000. So if you had bought and held stocks in that period, you're a wealthy man today. How did he pull it off? Again, if you continue to lower the cost of money and you expand the debt, you get a bullish stock market environment. Now, the lower the debt, the lower the rates go, represents a bigger bond market, and the more sensitive it becomes to changes of interest rates and inflation. Now, we don't even need 5-10% inflation to cause trouble. We just get the hint of inflation and we get a massive crisis. 2000, 3.4% inflation print. 2008, 3.8. You get those horrific sell-offs, but the Fed was able to pull their trick. They get the banks to load up on bonds, lower interest rates, buy them from the banks. Banks have a huge profit. Then they start up the QE, and the banks get to buy stocks at half off. And don't forget who owns the Federal Reserve. It's not the US government. It is the commercial banks. So they were able to pull this stunt off twice, as you can see, with cutting rates by about 5%. 2016, Powell came in. He was talking about interest rate hikes, quantitative tightening, hawkish monetary policy, all very good things in the long run. But the second we got a little sell-off at the end of the year, sure as day, he started cutting rates. So now you're sitting on the biggest bubble of all time in stocks and bonds, and we're at almost 0% interest rates with very little we can do to keep this expansion going. All right, so yeah, the big wild card now is whether the trade war escalates this year or next year, but the big picture really doesn't change. Whether we want to do a trade war or not, the bottom line is we're creating more debt than we are growth, and that is unsustainable. All right, guys, that's a wrap for today's presentation. Let's see if we have any questions out there. William, any questions? Ash? Brent?
Not today.
Yeah, you're getting a pretty good feel for how this all works, I think. So that's good.
It looks like the TLT, I paid a little bit more than you did.
Yeah, TLT is already climbing back. That TLT is dying to break out.
I think I paid 139.70.
Okay. We'll see how our SPY. Oh man, SPY's having a hard time hanging on to. I haven't seen the news over the last 2 hours, but so Trump needs. That's what I was really, I sat down and thought about what Trump tweeted here, and it's not a real agreement. He wants a pledge, so it's like a gentleman's handshake, and so it's almost hard for China not to accept the deal. It's almost like we're not even asking them to accept it. So yeah, we'll see if China doesn't essentially just reach out and say, all right, well, thank you for doing the tariffs. We'll accept that for now and continue talks, and we'll start making some more good faith purchases. If that doesn't happen, probably by Sunday, things might get hairy quickly. Now, if China comes out and says, hey, we appreciate the gesture and we in turn pledge to buy a whole bunch of agricultural products, then we might have a nice bull market on our hands. But interesting to see this sell off all day so far after, look at that, just straight up.
And William, did you go ahead and get the GDX position as well?
I did.
Good. Okay, good. And you already have SPY, right, from previously this week?
SPY, and I have the emerging market.
All right, William. Well, you're officially fully balanced now. Congratulations.
Yeah, so your portfolio has 1,500 stock companies, SPY and emerging markets. The GDX has 55 gold miners, but most of it's in the ones that actually can make money. Very little of your capital's in those junior miners. And then the TLT is the tax receipts of all America. Now we're playing the interest rate change and less so trying to make the coupon on it. But yeah, that's an extremely diversified portfolio. And it's very close to how Ray Dalio's fund is positioned. Now, Ray Dalio, he's managing $150 billion plus with, I think, 5,000 employees managing that money. And so they have to predict moves well in advance of everyone to position. So while we can react to the catalysts on the spot, which is really nice with our smaller position sizes, the big guys they really have to take a loss against the trend of the market and predict the change of trend before everyone else. And so if you've seen any headlines about Ray Dalio being down a couple percent this year, that's exactly what he's been doing right now. But yeah, our portfolio is very similar to Stanley Druckenmiller's, Ray Dalio, less so Jeffrey Gundlach, who I pay close attention to, has been actually betting down on the dollar, as well as Ray Dalio. So we've got some big funds trying to bet down on those two assets. All right, guys, any other questions out there? I see we have a guest with their microphone unmuted. Love to hear from you.
Yeah, and Ash, Brent, please feel free to jump in, guys. Ask us any questions you may have. There's no such thing as a stupid question. And, any way we can help you understand the program, I think the better off you'll be. And, if you have a question just about the financial ecosystem that Jason covered, please feel free to jump in. And just real quick, William, while I have you, did you buy 100 shares of SPY, or did you buy a couple hundred shares or a couple thousand? What did that look like?
No, I just have 100.
Okay.
I have exactly what your 75,000.
Okay. Nice.
I just want to see how this works.
Sure. Yeah, and that's what a lot of our customers do, William. They'll start with the, kind of minimum tranche, see how things play out over a month or two, and then slowly start scaling. And then, we talk to them 6 months later, and they, their maximum capital for their equities allocation is maxed out. So look forward to that process with you.
That did it. All right, guys. Well, thank you so much for your time. Hope everyone got a lot out of today's webinar. I do have a few other different presentations, which I'll probably roll out when the time's right, about China and Hong Kong. So we'll see how everything's looking tomorrow. But do continue to join our daily webinar. Take advantage of that. The intro is always unique. We always got the detailed explanation on the current trade. And then we also have the key news of the past 24 hours. So that'll always be unique and only available in the live. Then the follow-up presentation, I may rotate depending on what's going on in the market. So we may have some special presentations that are a little bit different than what you saw today, or a lot different. So thank you so much for your time. Appreciate everyone joining us live, and we'll see you back tomorrow.
All right. Have a good day.
Thanks, team. Appreciate the questions and the interaction, William. Jeff, thanks for coming out. Ash, thank you for coming out. Ron Brooks, appreciate it. Look forward to seeing you all back tomorrow. And if you all have any additional questions, feel free to reach out, okay?
All right.
My number, as you know, is 505-322-7515. Thanks, guys. Have a wonderful day.
Bye.